Joining us now is Neuberger Berman Managing Director Holly Newman-Kroft. Holly oversees $3.8 billion in assets under management, ranked by Barron's as one of the top financial advisors in the United States. Welcome back. Good to see you.
Good to see you both.
So these yields continue to rise, and I think it surprised a lot of people. How does that impact the way you think about managing the portfolio?
I think the way we position portfolios is we have to take advantage of the gifts the market's offering us today and also protect against risk. So as yields march north, our clients can get a really attractive yield in fixed income. So we're able to reposition client portfolios to get almost equity-like returns with a muni portfolio. So that takes risk and volatility out of their portfolio and also positions us to take advantage of when the market comes down, being positioned to do so.
We just haven't seen the kind of drawdown that you would like to see to get excited about stocks.
We're not excited about stocks, especially when you can get these returns in the fixed income space. You know, I spoke on your Financial Advisor Summit last week, and the question was, is the 60-40 portfolio dead? And I would argue it's maybe more alive than ever, but perhaps modernized today to include the alternative asset class space, because with the democratization of the alternative asset class, it's available more widely to investors. It offers higher yielding returns than equities. And so we can be overweight alternatives, as we have been all year, overweight fixed income. We maintain a neutral position in our equity space and just sit tight.
What percentage of your portfolio should be in alternatives?
That depends on the client and on the investor and their risk profile and also their income needs. Because remember, in the alternative space, you're sacrificing liquidity for higher return. So you have to be very clear with the client about what they're investing in, how illiquid it is, and make sure that you're managing on the other side of the portfolio for any income needs they might have.
Is 5 or 5.2 or whatever kind of overshoot we get on the 10-year mark a turn, mark a buy?
It might be. It might be. We'd like to see inflation come down. I don't know when, or there's some debate even if we're going to hit that 2% number. But if we can see inflation come down to about 3% and economists start to give some credibility to the fact that these higher rates are going to cause an economic slowdown, you know, the market has been buoyed by the consumer all year. And I think that these higher rates are going to be punitive both to the consumer and to stocks. So we're going to see when there's some credence to downward pressure on the equity market, we'll start to think about going back in.
Has any of the early evidence in whatever it is, airlines or travel, or been compelling to you so far?
Not yet. And I just don't think we have to take the risk. There's so much uncertainty in this market. The leading indicators remain negative. There is some suggestion that maybe it's such an unusual market that you can contradict all of history. But I just think it's not worth the risk today when you can capture other returns, or higher returns in safer asset classes.